Calls for one of the most talked about recessions in history are starting to recede. Bank of America now sees the Fed's interest rate hike ending in a, quote, soft landing.
You might have noticed that after many months of bracing for a sharp downturn in the U.S. economy, some prominent economists, CEOs, and market watchers have begun to sound a bit more confident that the U.S. will avoid a recession. But you might not want to count on it. Bloomberg's chief U.S. economist Anna Wong, along with a team here at Bloomberg, crunched all the numbers. And she's here to explain why a recession is in fact still likely on the way, and possibly soon.
There's always a chance that soft landing will be the reality, but I think that hinges on an assumption that this time is different.
I'm Wes Kosova. Today on The Big Take, why the landing might not be soft. Anna, you and Bloomberg's chief economist Tom Orlik write in this new analysis that when everyone expects a soft landing, brace for impact. Why do you say that? Why do you think that a recession is still the most likely outcome?
It stemmed from this observation where we look at the past recessions and found that indeed media mentions of the word soft landing and even corporate filings and corporate presentations research, whenever the word soft landing is at a peak, that actually precedes the 2008 recession, that preceded the 2000 to 2001 recession, the 1990 recession. There seems to be something there that made us to look deeper into why people tend to call on a soft landing right before a recession. And overall, our takeaway from that exercise is that there's more reasons to think that a recession is more likely than a soft landing.
So let's walk through the data that you compile for this article and all the things that went into this conclusion. You start the analysis with a quote from someone we're all very familiar with.
Yes, Janet Yellen. In October 2007, just 2 months before the Great Recession, she said that the most likely outcome is a soft landing. At that time, the economics data, very similar to today now, points to things looking rosier than everybody expected. Economic data were surprising on the upside. PMI was edging back up, which means Purchasers Manager Index. That index tends to be one of the earliest data that indicate whether the economy is accelerating or decelerating. So even that PMI survey shows an acceleration on the eve of the 2007 recession. So I think that the confidence one could place on the PMI surveys is, in terms of predicting the start of a recession, should be pretty low. We see a lot of similarities today. Our number one reason for why we still think a recession is most likely is because in the past recessions, the number one culprit for creating that recession is the Fed. And the Fed tends to murder expansions. And if you look at the lags of monetary policy, what we learned is that even within a tightening cycle, there are various lengths to these lags. So I think one reason why the soft landing believers think that the tightening effects of monetary policy is over already is because you see this reacceleration in manufacturing, financial conditions earlier when the stocks keep on rising. And we also see that housing market is starting to turn up. Well, it turns out that those places are also where the lags on monetary policy are the shortest. The place where monetary policy takes the longest to work is the labor market and also in the credit market. And there are reasons to believe that these two places, we have still yet to see the majority of the rate hikes effects. And once these two places, labor market and credit market, start seeing those effects, that is when you have this non-linear downturn that will jumpstart a recession.
And another thing you write is that a lot of the assumptions underlying projections are that the trends we've been seeing are going to continue moving in the same way, and that might not be the case.
When one thinks about soft landing, one is implicitly assuming that the unemployment rate will continue to stay low. But when you look at the lessons of recessions over the past 50 years, one thing that jumps out at us is that usually when this recession begins, you see this nonlinear jump in unemployment rate. It's very hard to forecast this nonlinear jump and when this jump will happen. I think the lesson is that when you look at all these mean forecasts showing a soft landing, showing that unemployment rate will stay between 3.8 to 4.1% next year, you are not taking into account the risks that skewed the distribution of forecasts on the upside. So once we put estimate on the risks based on historical episodes of recession, it just turns out that the upside risk of the unemployment forecast is way higher than low side risk to unemployment forecasts.
And one reason why these trends might not continue is that there are so many things that could sort of crash into those assumptions that are unpredictable.
So you're right. Recessions usually happen not because the economy slowly drip down to a low growth regime. It's usually due to a sudden confluence of shocks. And in fact, we are seeing at least 5 shocks in the immediate horizon. The first one is oil price shocks.
Oil has resumed a rally after an industry estimate pointed to a huge drawdown in US inventories, adding to signals that the market is tightening.
Aside from Fed funds rate hikes, the second most popular culprit of recession is oil price increase. We have seen a $25 increase in oil price in just a matter of a couple months. That would shave off growth from consumption spending. Another second shock that we're seeing is that people are starting to repay their student loans again.
Now to federal student loan payments returning after a 3-year pause. Tens of millions of Americans, they are back on the hook this morning, making those payments again amid stubborn inflation and rising interest rates.
We expect that will pretty much take off about $300 per household in consumption, in money that they could put toward consumption. Other than that, we still have a government shutdown risk. The stopgap bill that was passed over the weekend only kicked the can down the road to about mid-November, where there would be another shutdown negotiations again. So that will potentially lead to 700,000 federal workers being furloughed. On top of that, you also have the United Autos workers strike.
The United Auto Workers Union putting more pressure on the big 3 U.S. car makers, GM, Ford, and Stellantis. It plans to expand its strikes if there is no progress in contract talks by a Friday deadline.
Even though right now the strikes are pretty narrow, that affecting only 25,000 auto workers, we looked into the supply chain relationships of the auto manufacturing sector, and it turns out that the auto sector has one of the longest supply chain in all the sectors. In other words, even though the strikes are concentrated in auto plants, because it's sourced from so many other sectors such as steel, rubber, chemical, even service management consultant, when you have a paralysis of production in auto, you actually lead to layoff in all the other sectors. So we estimate that 25,000 auto workers strike could ultimately lead to 130,000 layoffs across all the other industries. If the UAW strikes were to broaden to the entire membership of the United Autos Worker Union, which is about 150,000 workers, that could ultimately lead to about 760,000 layoffs across the entire economy. So it's actually a pretty substantial threat to economic growth there. All these shocks could easily reduce about 1 percentage point off GDP growth in the fourth quarter and raise unemployment rate by enough to generate a recession.
And those are just the different shocks that could happen within the U.S. You also write that the rest of the world could wind up dragging the U.S. economy down a bit.
Let's talk about China then. China is the second largest economy in the world. Especially within China, the property market usually is a big factor in generating growth within China. Our team members from China are telling us that there is a structural weakness in the Chinese economy, some scarring effect within households after the pandemic that lead them to revise down China's growth through the medium horizon. If China does slow more visibly, that would affect commodity prices, that would affect the motivation to invest in equipment spending. Usually when you see global growth slow down, the first place you see in the U.S. economic data is in equipment investment. So that could further drag down GDP growth.
When we come back, can consumer spending ward off a recession? Anna, one of the bright spots in the U.S. economy, even with the recession fears, has been consumer spending has remained really strong. And now you're finding that maybe that might not last either.
One of the most popular cited reason for the soft landing is the resiliency of consumption rate. And I would say that there are two reasons to doubt why consumption should not be a key predictor. Number one, in past recessions, services consumption remain resilient even in a recession. I think the median American household consumer is not a forward-looking person. As long as you can borrow, you spend. So this is why even in a downturn, people still spend in services. Second, if consumption does slow down, that is additional bad news on economic growth. And we do see some good reasons why it would slow down ultimately. And one of them is that I mentioned the resumption of student loan payments. We think that that would altogether add up to about $70 billion per year spent on paying back student loans instead of spending on things and services. Another reason is because all these pandemic savings that people had from either a paycheck from the government or from forced saving because they were not able to spend during the shutdown years, those savings are running down for about 80% of American households. And finally, this summer, we actually saw a once-in-a-blue moon kind of consumption spending splurge. That's due to three cultural phenomena in the U.S. Number one, you have the Barbenheimer movie release that led a lot of people to go back to movie theaters. And number two, you have Taylor Swift concert tours in the U.S. On top of that, you have Beyonce's concert tour in the U.S. as well. Imagine this. Each person, on average, who go to a Taylor Swift concert pay $1,500 for altogether the concert tickets, hotel, fans, memorabilia, airline tickets. And for Beyonce, the average concert goer spent even more because the typical fan of Beyonce is older than a typical person who goes to Taylor Swift concert. So what you see is then a Q3 Barbenheimer, Taylor Swift, Beyonce explosion of things that cause people to spend irrationally because they just want to go for it. And then in Q4, you have this nuclear winter of entertainment because of Hollywood writer strikes. No more Taylor Swift, no more Beyonce. So you have this cliff of services spending. So what we are expecting is that this big drop-off in consumption spending will start to become evident in consumption data in the coming months.
And Anna, you actually were able to put a figure on just how much all of these cultural events added to the U.S. economy.
Yes, we estimate that those three things together added about $8.5 billion to the third quarter growth. So in annualized gross domestic product growth terms, that is about 0.5 percentage point. You added 0.5 percentage point to Q3, then you must have 0.5 percentage point subtracted off Q4 if you no longer have those growth drivers.
That's an astonishing figure that those things could have such an effect on an economy as large as the U.S.'s.
It's like an Olympic event, basically.
And you said that people will spend as long as they're able to borrow. And that's another thing that you found in your analysis, that banks are starting to become a little stingier when it comes to lending out money.
We were searching for the one indicator which has a good track record of predicting a recession. And when I was reading the October 2007 FOMC transcript, I note that their staff was talking about all these positive economic surprises. But then the one indicator that showed that something bad is happening is the Fed Senior Loan Officer Survey, or short for SLOOS. That survey tells you what are the plans of banks in lending. And typically, when banks indicate that they're planning to reduce lending to consumers, reduce lendings to firms, that has been a very good indicator of credit tightening. And when you don't have credit flowing freely in the economy, that's when you start to see more clearer signs of slowdown in growth.
When we come back, what would it take to avoid a recession? This is all painting a pretty bracing picture of what may be ahead of us, and yet you also lay out what you call the arguments for the defense, the reason why maybe this won't come to pass and we will have a bit of a soft landing. Can you tell us what they are?
The best argument for a defense is if you believe that there's a productivity boom underway, possibly from AI. If you look at the past 50 years of history of Fed hiking cycles and soft landing, there had only been one successful case of soft landing, which happened in the mid-1990s. And that was because Alan Greenspan decided not to further hike interest rates because he strongly believed that productivity growth is rising. Therefore, wage growth could continue to increase without generating inflationary pressure. In this case, lately we have been seeing a lot of labor strikes, right? And the settlement of these labor strikes shows that people are asking for 4 or 5% wage growth per year, and not only for this year, but in the next couple of years. In order for that to be consistent with the Fed's 2% inflation target, it means that productivity growth got to pick up to around 2% or even 3% from about 1.5%. I believe that the Fed believes that trend productivity has been running at about 1.5% over the last couple of years. So if you do believe in that AI boom, the Fed would allow this wage growth increase to happen and sit back and let productivity do its work. But I would say that to have confidence about this judgment that productivity is rising is as hard as having confidence over what the neutral rate, the R star, is. And I think Fed Chair Powell will not have that kind of conviction, strong enough of a conviction of a productivity boom underway before he paused the rate hike.
And then some of the things that you're watching, which could spell bad news, you say, could turn around and wind up actually being good for the economy.
Yeah, I mean, it could easily be that the UAW strike could end tomorrow, and then government shutdown could be completely averted if Republicans and Democrats decide to work together. And all that disruption would just be a rounding error for Q4. It could also be that Bidenomics could be successful in reversing decades of economists' understanding of industrial policies, which is that while government subsidization actually helps spur private investment in these selected sectors, and as a result lead to an investment boom in the U.S. If that happens, we can totally avert a recession.
But I think we can all hear the skepticism in your voice. You don't really think that that's likely.
I think it really stems from our exercise in this piece of article, which is we go back to history and look at the probability of what is the most likely outcome. And yes, there's always a chance that soft landing will be the reality, but I think that hinges on an assumption that this time is different. And I just feel like it's such a hard argument to make that this time is different that I would still say our base case is a recession.
Anna, if a recession does come to pass, is there any way of telling from all of these numbers that you're looking at how deep it will be and how long it might last?
Our base case is for a short and shallow recession, but it is a very low conviction call because usually when a recession happens, it's because all the shocks hit the economy at the same time and some kind of non-linearity effect is happening. It's kind of like somebody in the movie theater is shouting fire and everybody rushes out of exit. It's usually a kind of like a freak out moment. It's hard to tell how severe it would be once those dynamics kick off.
Anna, thanks so much for giving us a look at what's to come.
Thanks.
Thanks for listening to us here at The Big Take. It's a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you listen. And we'd love to hear from you. Email us questions or comments to bigtake@bloomberg.net. The supervising producer of The Big Take is Vicky Vergolina. Our senior producer is Catherine Fink. Federica Romaniello is our producer. Our associate producer is Zenab Siddiqui. Raphael M. Seeley is our engineer. Our original music was composed by Leo Sidran. I'm Wes Kosova. We'll be back on Monday with another Big Take. Have a great weekend.